Canadian income taxes today. The federal and provincial governments still have the authority to impose direct taxes. Income tax is levied on taxable individuals by the federal government and the governments of all 10 provinces and 3 territories. In 1962, the federal and provincial governments established the tax collection agreements, which allow the provinces to impose their own individual income taxes and to accept federal tax collection and administration of the tax system. The result is that in all provinces except Quebec, taxpayers complete only one income tax return each year. On November 1, 1999, Revenue Canada was replaced by the Canada Customs and Revenue Agency, CCRA. The purpose of the change was to streamline the federal and provincial systems to reduce the overlap and duplication of various programs. In December 2003, the CCRA, which was responsible for customs as well as revenue, was split into the Canada Border Services Agency, which deals with customs, and the Canada Revenue Agency, CRA, which is responsible for administration of the tax laws. As a result of this change, many tax programs that were previously administered by the provinces are now administered by the CRA. The Income Tax Act is still administered by the Department of National Revenue, with the Minister of that department remaining accountable to Parliament for the administration of the CRA. In addition to collecting federal tax payable, the CRA continues to collect tax payable to all the provinces and territories, except Quebec, and turns those amounts over to those jurisdictions. Residents. The Canadian Income Tax Act, unlike the equivalent legislation in a number of other countries, uses residence, not citizenship, as a criterion to determine how an individual's income is taxed. For income tax purposes, an individual is either. This course deals only with the preparation of tax returns for taxpayers who are ordinarily residents of Canada. Non-residents, immigrants, emigrants, and related residency issues are covered in other courses. An ordinarily resident, resident throughout the year; a non-resident, not a resident at any time during the year; an immigrant or emigrant, only resident for part of the year. Illustration 1:1. Self-assessment system. In many countries, tax calculations and deductions are made strictly at source by employers or government tax collectors, and no tax return is filed at the end of the year. In contrast, Canada has a self-assessment income tax system, which requires taxpayers to determine their own tax liability each year. Under our self-assessment income tax system, taxable individuals are required to determine their taxable income for each taxation year, and then calculate their tax payable. This amount is compared to tax already paid. If the total credits exceed tax payable, the excess is refunded. If the total credits are less than the amount payable, the taxpayer must pay the balance owing. These calculations are made on an income tax return that must be filed with the government. Progressive tax system. Canada's present system is called a progressive tax system because it imposes lower rates of tax on low incomes and progressively higher rates of tax on higher incomes. For 2020, the federal tax rates were. Underlying the system of progressive taxation is the belief that low-income persons should pay relatively less tax because they are obligated to spend a relatively high proportion of their income on the necessities of life. High-income persons, on the other hand, have more discretionary income with which, among other things, they can pay tax. One of the characteristics of the current progressive system is that it levies tax individually, not on a family basis. As a result, a family in which one spouse earns $80,000 will pay several $1,000s more in tax than a family in which each spouse earns $40,000. Even though the gross family income is the same in each case. 15% on income of $48,535 or less. 20.5% on income between $48,535 and $97,069. 26% on income between $97,069 and $150,473. 29% on income over $150,473 and $214,368, 33% on income over $214,368. This is because in the first situation, more than half the income is taxed at a federal rate of 15% and the rest at 20.5%. In the second situation, all the income is taxed at 15%. Provincial taxes. Outside Quebec, provincial, territorial taxes and credits are calculated on special forms and then added to the federal totals, so that the refund balance due calculated on the federal return includes both federal and provincial taxes. In Quebec, provincial tax is calculated on a special return that is filed with Revenue Quebec, so the refund balance due on the federal return includes only federal taxes. In this InkDoc, we focus on federal taxes only. A special supplement covers provincial, territorial tax for each jurisdiction. While progressing through the course, the instructor will point out where the provincial, territorial tax rules and calculations differ from the federal tax rules and calculations.